My topic of today is a bit out of place, in a sense, if you look at the other topics, but I will try to make it fit. So I'm going to talk about whether the classical gold standard can be viewed as a proxy for the euro. In a recent article, Jesus Puerta de Soto from Spain has argued, I think that was June last year, that the euro should be seen as a proxy for the classical gold standard. And why is that? Well, there are several analogies, right, or similarities, if you want. One of them is, well, when joining the euro, governments gave up monetary nationalism, just like under the gold standard. Just like under the gold standard, the common currency, according to Puerta de Soto, forces countries to reform when they're in crisis, otherwise they have to leave, right? So therefore, in order to limit state power and to limit and to encourage market reforms, for instance, in Spain, as he argues in that article, he says, the euro is not so bad. Actually, it should be seen as something as a second best to the gold standard. That's what he argues in that paper. Good. So governments do not have the ability to inflate away the debt. So that motivated me to have a look at some other books and stuff on that topic. And there's a good book arguing it by Ben Steil and Manuel Hinz. I think it's published by the Cato Institute, and it's about monetary sovereignty and globalization, talking about exactly the same issues, saying that whenever there was globalization, there was or globalization was on its height, there was something like a monetary standard. The euro, which is a monetary standard for a smaller zone, is something similar. So it's the second best. Okay. So from that perspective, of course, free market economists should probably be in favor of the euro, or be in favor of the euro in general, or not be too skeptic about the recent developments. In this paper that I had to write for this conference, I was trying to turn the argument around. Not really turning the argument around, but I named it the classical gold standard, a proxy for the euro. So what I was trying to do is, I was trying to what we're going to see here is, I'm trying to find similarities, but also differences between the euro and the gold standard, right? And hopefully we can learn something from that comparison. So it's not really an economic talk where there's some economics in it, right? We pretty much compare some things. And what I'm comparing is pretty much the degree of capital market integration that emerged under both systems, like the classical gold standard, which is the gold standard up to World War I, not the one in the middle. I don't want to deal with that messy thing. And the euro area. Plus its connected EU members, for instance. But I also want to look at the institutional setup of those of the two systems, and I do feel that there's the real difference between the two systems, between the gold standard and the euro, because which matters in the way that countries deal with the crisis. So let me start with the gold standard, just to talk about its development. Well, we all know, or most of us probably know, that the gold standard was not a politically driven, centrally planned project. It was not based on a big agreement, a big conference, or something like that, like Bretton Woods, right? It was not based on that kind of thing. What it actually was is, well, there were governments that actually did see the need for some monetary standardization to promote trade, to promote economic growth. But actually, countries had to decide themselves to join it. So what were the reasons for the development of the gold standard? It really emerged decentrally, right? So the reasons were, well, first of all, why gold made the race in the 1880s were Most importantly, Britain was on gold. Britain was the major economy, right, with the biggest and most deepest and the deepest financial markets, and being on gold as well allowed to lend more cheaply from Britain. Also, it was supposed to improve trade, like you don't have all these nasty volatilities, you don't have to exchange monies and all that. That's terrible. So countries saw the idea that going on gold would be a good idea to reduce transaction costs and increase trade. But what really eventually helped the gold standard was that by, I think, 1879, the most important countries all were on gold. So first the UK was on gold, then at some point Germany decided to go on gold, and the United States went on gold. And Eichengreen says, with the major three industrial economies on gold, a new world order was born. So there's a network effect, right? If everybody's on gold, that is like able to lend you money, then you go on gold as well. Well, the thing is, and that's of course a major difference to the euro, is that that because the gold standard was not centrally planned, there are no formal rules or agreements. You know, there was no conference, there was nobody having a contract, signing. Now, if you are going to join our area, you're going to not hit the 60% debt level or something, you know? You're going to stay below. There was no such thing. However, countries also did not give up their own currencies, right? They went on gold, so they pegged their currency and to gold, so to a gold parity or to a country that is pegged that was on the gold standard, and then that's it, right? So what was possible for them is also to leave. So it was easily possible for those countries to leave the gold standard, and we will see that countries did that every once in a while. Okay. Now, why did countries go? Well, or why did they stay on gold? Well, there's some that argue that governments had a self-interest to try to remain on gold whenever there was like fiscal trouble, because if they were on gold, they were able to lend at a lower cost, right? So that makes sense. It's a market argument, right? The market regulates the government. That's what the gold standard should do, right? This is kind of in line with what Huerta de Soto is talking about. However, there are others that say that really the drive or the impetus to staying on gold came about by the elites that favored stable prices, and they favored stable prices, and they didn't want to lose their money, right? So they were like looking for long-term sustainability and kind of conservative fiscal policies, right? And so they were pushing governments to do those policies. That's what other people say. Well, now, what's the difference to the euro? Well, the euro, in contrast to the gold standard, of course, is a centrally planned project, right? It's set up as an island of monetary standardization within a world of flexible exchange rates, if you want, right, and free capital flows. The introduction of the euro was more like a political process, so it's not like there was. It's not like the economic reasoning was at the forefront. No, it was seen as one thing in line in order to bring about a political union within Europe. Maybe some people argued the euro would eventually give Europe an identity. Is one argument. There are also economic arguments for the euro. I don't want to leave them out. And the economic arguments for the euro were quite similar to those of the gold standards. Here's a similarity, right? So there was the economic arguments were where there's a bunch of papers by Rose and Frankel and all these people saying that, well, in currency unions, there's just more trade because of all these, because you get rid of all these transaction costs and all these bad volatilities. There's more trade and there's more growth, and that's beneficial. So there was a big currency union effect that people were expecting, that would enhance trade, and that was really the main economic argument, I guess, for introducing the euro. But of course, the countries, as I said, on the gold standards, they did not have an agreement, right? They didn't have an agreement among each other. But the members of the euro, of course, they did make some agreements. So they introduced lots of institutions. There was lots of institutional integration. We know that there was, first of all, they had to be members of the EU, right? Which already means that they were going through a process of harmonization. They also had to guarantee, or the euro area also set up institutions that sound similar to the Gladstonian Trinity of Britain. That they were supposed to guarantee free trade, stable money, and balanced budgets. So what were those three institutions? Well, one of was the Single Market Act, right? That guaranteed the free trade and factor movements. Then you had stable prices. Therefore, we have the ECB, right? For most countries, the ECB was actually able to stabilize prices more than the old central bank did. So there was definitely an improvement in that, if you want. And of course, there were the Maastricht convergence criteria, right? Countries had to converge before they were able to go on the euro, and those convergence criteria, of course, did not exist for the gold standard, right? So countries had to go into, there were some debt limits, there was some inflation requirement. So in order to join the euro, countries were trying to get their macro fundamentals in order. So the institutional differences are quite substantial, right? And if you look at all these institutions, you see that there's institutional differences, then you see that the euro area, there must be more political commitment to the euro than there was to gold. Right? Not just one-sided political commitment from the country that may have had an incentive to staying on gold. No, but it's like a two-sided commitment, right? You have all these institutions you set up, all these people working there as well. But not just that, it's also this process along the line of history that was supposed to bring a political union. So you have a two-sided process, right? And that, in the end, we will see makes a difference in how countries behave when they're in debt crisis. But let me first start with capital market integration. So we've seen that the institutional setup of the countries was really, or of the currency regimes was really different. But I also want to show you some graphs, so I'm not the only one not showing you anything. Let me talk about capital market integration first, because I do think there's some great similarity between the euro area and that of the gold standard. This is a graph that is there a pointer? Yes. This is a graph that shows that shows government bond yields spreads over the British bond yield. That's what should be written up here, actually. I just summarized that as capital market integration graph. From 1870 to 1912, you have several countries, Germany, Italy, France, Russia, and Spain. I put them over here because those three countries were usually on the gold standard, and those two countries usually were not on the gold standard. Spain was never on the gold standard in that period, as far as I know. So what you saw is that during the period of while the gold standard was set up, you've had a period of grand globalization, right? So there was a high degree of international integration. Some historians today refer to this period as a first era of global finance, which was going along with that. There was new communication, there was new technologies, people could suddenly travel easier, there were railway services all around the world, so the world was growing together, and so were capital markets and financial centers. And when financial centers grow together, they start to invest in each other. So they were allowed to do that, actually, and you see that there was a high degree, when you look at the gold standard period, you see that there was a high degree of convergence in many things. First of all, you've had countries that went on gold typically had relatively low government bond yields. The spread towards the British consols was relatively low. Here you see Germany. The German spread over the console was about 1% over the entire period, right, of the gold standard. That Germany was on the gold standard, started about here. And you see that this low interest rates, this low long-term interest rates, allowed for substantial capital flows to other markets. So you had even countries or even bonds yields of other economies that were not on gold converging towards those of Britain, because investors were able to funnel lots of funds around the world and invest where it's most lucrative. There's lots of empirical evidence that during the period of the classical gold standard, you've had no or hardly any correlation between savings and investment, domestic savings and investments, and that should be surprising, because today you do have that. There's a famous test, the Feldstein-Holyoka test, that suggests that having capital markets that usually that brings up a puzzle that tests for the correlation between domestic savings and investment, and it says that for some reason they're really correlated, but that test does not hold for that period, because there was substantial investment in other countries where the yields were higher. So the Feldstein-Holyoka puzzle really is about that for some reason, even though markets are open, economy or investors do not invest where yields are or where they get the highest return, right? And that's why you have this weird puzzle. Good. So you have had a high degree of capital market convergence during the classical gold standard. Now, let's go to the EU. Also within the EU or within the euro area, capital markets converged quickly, right? From 1996 onwards, you see that this is again bond yields. Here I did not. This is bond yields over the German bond rate. So it's not over the British console anymore. Now this is over the German console, which would be the reference for the euro area. And you see that with the introduction of the euro, bond yields all fell down, and the spreads narrowed significantly until here, and I present you that later on. And because this is the part where the convergence is not there anymore. So with the introduction of the euro, what happened is that suddenly there were higher expected returns in periphery countries of the euro area, for instance in Spain and Greece, right? But also in Central and Eastern Europe, there were higher returns than in, for instance, Germany, and so you had substantial capital flows flowing to most of these economies. They brought about a growth in wages, They brought about lots of convergence in general, because GDP levels of Greece at some point, per capita at least, were almost close to the German level. So if you look at that, there was a lot of convergence going on in the first period of the euro as well. So there's another similarity between the two, right? So if we look at it, we do have different institutions, but we have hot packs, right? And we have lots of capital market convergence or integration. Okay, so what does this integration hinge, or what drives this bond yield convergence? Well, there are two views for the gold standard. One view is that the gold standard itself, every country that credibly maintained convertibility to gold over a long period would benefit from low rates, low yields, right? We're not here yet. So the adherence to the gold standard, of course, you don't have your own monetary policy, so the adherence to the gold standard, what's it doing? It's reducing inflation expectations, and for some reason, maybe it signals to some people that this country is actually willing to keep fiscal policy, let's say, sustainable. Okay. On the other hand, and this is a different argument, you do see spreads, right? And at that time, information was not bad, so it was possible for everybody to get information on political events, or to get data about countries and what's happening. So it is possible, or the other argument is that it was really the trust and the reputation of the policy that drove capital market integration. Potentially, being on the gold standard, just as being on the euro, was one good signal, right? But you do see different yields still for countries, and if you regress the yield on the fiscal deficit, you will find something significant. Whatever that means, but let's say it means something. So you do see, you can explain the difference in yield spreads by fiscal variables, even in the gold standard period. In that context, Neil Ferguson has an interesting idea, and he says that it's the institutions that matter, right? Whether countries trust, or whether investors, whoever, in China, countries, and other countries, investors invest somewhere or not. And he says that, for instance, he found that the colonies of the British Empire, for instance, had to adhere to the British rules, right? So they had protected property rights. For that reason alone, because people were foreseeing or anticipating that they were getting their return, they were having, they were benefiting, and they were having lower yields than countries that were not a colony. And they actually make an analysis showing that countries that are like poor countries that wanted to borrow in international markets should better become, and that's actually funny, should better become a colony than go on the gold standard, right? Because of the institutional variances. Okay, so it may have different aspects, and we're gonna look at them a little bit now. Because when it comes to the European experience, we will see that actually fiscal policy credibility and price movements mattered much for the sustainability of the gold standard, but also for sustainability of government finance. We see that in this graph. We see the debt to GDP ratios of several countries from from 1880 to 1912. This is the gold standard period, pretty much. These are the core countries. There are some more. I dropped some Scandinavian countries to not have too many on them on here. But you see that debt to GDP ratios differed substantially between the core countries even, right? Yet, they faced relatively low borrowing costs. So maybe the debt to GDP ratios, and I think this is what you were showing as well, alone do not say so much, right? Okay. Here's the debt to GDP ratios for some southern European countries during that period, and here you have Portugal and Greece as you will see that just when you look at the levels relative to the countries that were usually on the gold standard, you will see that the levels are a lot higher. Well, you do have some here, like you have some countries, but they were at least having declining debt to GDP ratios, right? Which is convergence towards something. But here you see that the average was relatively high, so it was around 100%, while for the core countries it was on average about 60% debt to GDP ratios. So that could have mattered why those countries, for instance, faced problems. And there's a good reason why they faced problems. Let me go to this later. First of all, those countries with high debt to GDP ratios during the gold standard period, so I don't speak too long, will face problems in deflationary periods. Interestingly, the gold standard period, you can divide it into two periods. One before 1896 and one after 1896. When you look at the one before 1896, you see that there are several deflationary periods, right? After 1896, the gold standard was, like the euro, inflationary, if you want. Right? Interestingly, exactly when deflationary pressure was emerging in Portugal in 1891, Portugal became huge fiscal problems, was not able to adjust, and went off the gold standard. And this is what I was trying to show here. Some people, often people consider the period of the classical gold standard as something very stable. But it was only after 1900, if you want. Because before that, you even had countries dropping out, going in, dropping out. This is, I think, Greece. They were in for like 2 years or so, and then they were going in. And some countries were able to join the gold standard a bit later when they were ready, or when inflation was already on its way. What you see here is, this is the height period, the period of when all these countries that were previously not on the gold standard joined the gold standard. You see that the inflation rates were positive. So what I'm trying to say is not that we need inflation rate to have a stable money system, but what I was trying to say is here that it depends, that the policy or the fiscal credibility does not just depend on the debt to GDP ratio, but more on the expectations, whether they can be met, right? And in an inflationary period where there is a lot of growth, countries like Austria, Hungary, back then relatively less developed countries, or Russia were able to join the gold standard and were able to maintain that, and were even able to benefit from low borrowing costs. But when you had deflationary pressure on government finances, and then you had a little shock like the borrowing crisis in 1890, then countries such as Portugal had to leave the Euro area. And they did so it's not like the gold standard, and this is kind of what I'm getting at, is I do not think that the gold standard really is the system that keeps policymakers from messing up. So in order to keep policymakers from messing up, you just have to restrict fiscal policy in total, in a sense, right? I mean, they can still do fiscal policy, and it may seem sustainable for a while, but at some point, everything changes, and it's not sustainable anymore. And the same thing is true for the euro area. You have debt to GDP ratios, as we've seen today already, that are quite substantial in all countries. I think we've seen that it's about 79% in Germany now, or 75 on this other chart. But from this debt to GDP ratios, there's no reason why Spain would have a crisis, right? I mean, why the hell does Spain have a crisis? It's low, right? So there must be other factors, and of course there's this credit boom that went bust in the south and also in the Baltic countries, for instance, and this produced a deflationary scenario on the economies, and that produced debt problems, right? The problems because the sustainability of the policies were not credible anymore. And interestingly, why does Portugal not go? And this is the commitment. That's why I introduced the institutional differences. Well, Portugal went off the gold standard in 1891, right? Why don't they go now when they face the same problem? Well, of course, there are institutional incentives that keep them on the euro. On the other hand, it's not just the incentive that there is the institution. There's also an institutional incentive for the euro area to keep them, because it might destroy the euro area, or it might have some other effects on other members or whatever. So there's like a two-sided relationship that prevents them from going off, as they did in the gold standard period, and it's not. And I believe the harsh reforms that we see in Spain cannot be really traced to the euro being very much like the gold standard, but more to the institutional constraints that countries face, and that's why they don't leave. And I have a lot of more slides, but I will not bore you anymore, and already have drawn my conclusion, and therefore I hope that we can discuss this a bit. Thank you very much.
Thank you, Andreas. We've heard 3 presentations. I guess it would be appropriate to have room for 3 questions, so that we can then spend most of the time debating privately and drinking wine with it, which will be pleasant, I'm sure. So 3, max 3 questions or comments. The floor is now open.
There were nice chart. Could you skip back to the chart with the GDP on a gold standard? Yeah, wait, previous one. More previous one. More previous one. That's one. Okay. Well, you see the debt to GDP is going down during that time on a gold standard. Wasn't it because the countries which would go out of the gold standard would face like larger borrowing costs, and because they went out of a standard, logic of the investors would be like, okay, we will not borrow the money because they will return us worthless paper like Greece. So we will invest more likely in Britain. So it kept countries more in the on a gold standard, and during a time that investors are most likely will invest in the countries with a lower GDP, like government's bonds in Sweden, because they have GDP debt to GDP only 20%. So it would the system would automatically keep countries in reducing the public debt, but in in the euro, it didn't happen because there was constant expansion of a monetary base, like which kept the yields down. Do you see that in the same way?
All right. Maybe what if we collect 3 questions and then you use mic and answer all of those, or you all 3 indeed. So any other comments or questions? Yeah, there is one more there.
Thank you, Dan Šťastný, Prague School of Economics. Given the title of this seminar, European debts and what's next, or something, it was very suggestive, and I was thinking that I'd like to go home with your opinions, at least the opinions of you 3, about what's most likely scenario that the world's going to take. I mean, EU is going to take. We heard there are 4 possible options: debt relief, debt repudiation, and monetization, pretty much. And I mean, the link I find between the debt and this last presentation of Andreas was that, of course, euro offers a solution of monetizing the debt, right? And my hunch is that, although it's not perfect, I mean, gold standard is not perfect, euro is even less perfect probably than gold standard, but still I find it hard to claim that it would make it easier to monetize the debt. I still think that monetization is the most likely scenario, but I think that the contribution of euro makes it harder than if we had separate currencies. And I wonder what your opinion on that is. Thank you.
All right, which I guess is partly what Jesus Huerta de Soto is claiming. And one last comment or questions? Yes, please.
Please, imagine the best case scenario. Let's say we manage to monetize the debt and we erase the debt. Something is done about the debt. What then? Where is some guarantee that the same or similar thing never happens again? Where is something to prevent European Union becoming from permanent machine on the debt, where we do nothing else but pay off the debt?
All right, thank you. Now it's up to you 3 to respond, and that'll be the end of our formal session.
Well, first of all, thanks for the question. I do think there's... I was trying to explain that it does not just depend on debt, it also depends on GDP. So in a sense, there's also a denominator, and therefore it's not true. I do think it's not true that to say that the gold standard itself provided provided for this scenario. I do think it is kind of an accident of history that countries that were on the gold standard were doing so well, the core countries that were doing so well, because if you just look at Portugal, they were on the gold standard at the very beginning. They were long on the gold standard. However, it's just an example. Of course, you could say, well, they're an outlier, let's erase them, right? But they were on the gold standard, and as soon when there was a bigger crisis in 1890 in Portugal, there were a country that entered the gold standard on a higher debt to GDP level, right? So, and well, first of all, this signaled some sustainability. Well, probably they're going to be nice now. Probably they're going to do something for staying on the gold standard. But as soon as you had deflation, they were not able to be nice anymore and do something to be able to stay on it. So as soon as you had prices moving in the opposite directions, then was optimal for the Portuguese to finances. They faced major problems, and at the same time GDP went down, so they had to leave the gold standard. Today they do not leave, in my opinion, because of the institutional barriers I explained, and also because there are incentives, incentives and bailout mechanisms that help them stay on the euro, right? So, all right.
Right, so just briefly on those questions, number 2 and number 3, what's basically going to happen? Answering really briefly, in my opinion, obviously the Eurozone is going to survive, and if we were going to bet in any way which country blocks or unions would there be in place in, I don't know, 2040, 2050 or something safe in the distance like that, I'm completely sure that in my opinion the EU and Eurozone will be around, unlike some other countries, unions, perhaps. That's just a mixture of my political, economical developments take on those issues. And the final question about those guarantees preventing future build-up of debt and imbalances in the EU and Eurozone. Basically a factual comment. There are some initiatives which aim it is indeed to deal with those risks of such build-ups, issues to manage risks in the financial markets and the real economy in a better way, creating new institutions, new organizations, and we shall see about what they will bring up in terms of results, obviously. Yeah. Thank you.
Just a short reaction on the last question. In my view, there is no guarantee that will prevent this crisis to happen again in future. I think that to prevent this situation in future would need to change the institutional background of the monetary policy, to change the inflation view of the world, so that inflation has to rise forever. So this is what, in my view, needs to be changed in future.
And perhaps, I guess, last word by our foreign guests on the key question: is there anything better than the current euro? We can have many problems with how it works, but isn't Jesus Huerta after all right that it is a second best? Is it, or it is not? That was the second question, I guess.
It can be.
Switch it on.
Well, it may be the second best. The other option would be right now default in many countries, right? The euro area is allowing those to keep those countries alive, if you want, to keep them on the credit market. I'm skeptical. I think what you would have to do, what would be the guarantee is, if you want to avoid default, don't go into debt, right? Because you never know whether the underlying assumptions. It's just when you take out a loan and you and you base it upon what you actually make at the moment, right? And suddenly you're unemployed, then you might default on that loan. And it's the same for state finance. So we have the parallelism again, and therefore. I think this is the major message, to restrict going into debt in general, because whatever your argumentation is, this usually is the cause of debt crisis.
All right, which means we are back. We can actually, as a conclusion of this seminar, call the title of Rogov's book, which is called "This Time is Different." So we always seem to believe that we already know how to fix the world, that we will never repeat the bad policy choices of inflation or debt, but it seems that we actually do it over and over again. So on an optimistic note, maybe this time we will learn our lesson and we will be more careful in believing that that is good for development, or that inflation is actually good for economic growth. It is not. Neither is true. And I hope the message will be circulating around also partly because of our analysis today. We covered a lot of topics. We went from Europe to China, from late 19th century gold standard to the problem of Portuguese today. However, I believe there is a strong unifying line in the argument, and I will encourage all of you to read the papers which will be published in Policy Series number 2 of CEVRO Institute, which will be sold or given away in certain instances. In any case, thank you for coming. Thank you, especially our speakers, Andreas, Josef, and Václav. And I look forward to less official and less formal debate now here in our submarine club. So thank you for coming, and keep coming again. Thank you.